If you're searching for some high-income dividend stocks for your dividend portfolio, then stay tuned as I'll share 3 high-yield dividend stocks and why they are worth buying right now. But first, what makes these high-income dividend stocks stand out from the rest of them that you see on YouTube? Well, my search focused on high-income dividend stocks with sustainable payouts. Instead, I prioritize companies with strong financial health that include solid balance sheets and steady cash flow so that their dividend can handle tough times and we don't have to worry about them slashing their dividend payments in the future. So what is the first stock and why is it worth buying? Well, the first company is listed on the FTSE 250 and provides online trading services for a range of financial products internationally. While the past year's performance shows a 3% decline, this stock has seen very positive momentum in the past 6 months with a 19% gain. The price to earnings ratio remains at an attractive 8.6 times, which is below both the UK market average of 11 times and the company's own historical averages for the past 5 and 10 years. Over the past decade, the net income has increased by 148%, while market capitalization has only grown by 25%. This trend in market cap growth aligns closer to that of the free cash flow growth of 28%. So the financials are solid, but is this a safe stock? Balance sheet reflects a strong financial position with a low debt to equity ratio of 15.5% and healthy liquidity demonstrated by quick and current ratios exceeding 2. The stock offers a semi-annual dividend paying in March and October each year and has a yield of 6% with a consistent payment history dating back to 2006. However, dividend growth has been more on the modest side with a 5-year compound annual growth rate of 0.91%. Nevertheless, a moderate payout ratio of 52% indicates ample room for maintaining dividend stability during potential earnings volatility. I think that a fair price for shares of this stock is around £11.35. This stock is IGG, named IG Group Holdings. If you're looking for stock inspiration and would like to see which stocks I hold in my portfolio for free, then click the link in the description down below. The next stock is a US home furnishings retailer listed on the NYSE. Over the past 5 years, the stock price has almost doubled, up 74%, but it has been rather quiet lately, staying relatively flat over the last year and continues to trade 33% below its pandemic high. The stock's current price to earnings ratio of 8.5 times remains considerably lower than the US market average. So why have shares stagnated? Well, the company's profits have more than doubled in the last 10 years, up 177%. The undervaluation is further strengthened by the significant 28% reduction in the total share count, which suggests substantial buyback activity. I think that some investors are concerned that the growth isn't sustainable. The debt to equity ratio has seen a fairly significant increase from 19.8% to 64.6% in the past 5 years. The stock features a quarterly dividend paying in March, June, September and December with a respectable yield of 3.7% and a conservative payout ratio of 29%. However, its appeal is enhanced by regular special dividend payments, which can increase the yield to 6.4%. Notably, this stock boasts a strong dividend track record, having paid dividends in 19 of the past 23 years and achieving a 10-year CAGR of 16.34% in its regular dividend. As long as this stock can maintain its healthy margins, I think a fair price for shares of Havati Furniture Companies is around $50.37. I think that most investors are overlooking this stock. It's on the FTSE 250 and helps companies find people to hire, but the stock price has barely budged in the past year, up only 1%, and even slipped a bit over the past 5 years, down 3%. The price to earnings ratio of 14.8 times sits above the UK market average. However, excluding the exceptional year of 2020, it aligns with the 5-year average and remains significantly below its 10-year average price to earnings ratio. Even though the company's profit has been growing nicely, up 34% the last 5 years, the business is very efficient with a 44% return on capital employed, combined with moderate debt to equity ratio of 22.3% and comfortable liquidity levels. The stock offers a biannual dividend paying in June and October each year with a yield of 3.5% and a payout ratio of 50%. Like the previous stock, this dividend is boosted by special payments, performance, which can actually rack this yield all the way up to 7%. This stock has a strong dividend track record, like the last, paying dividends in 19 of the past 23 years. While the dividend CAGR of 2.9% over the past 5 years suggests perhaps a limited future growth outlook, based on a discounted cash flow valuation, I think a fair price for shares of Page Group is around £4.36 each. However, these stocks that I've mentioned so far on this list might not be growing fast enough for your attention. Do I know of any other good dividend stocks? Well, yeah. Click here to learn about these 3 fast-growing dividend stocks.